Hello, everyone. Welcome. You're in the right place. We will just wait a minute for people to come into the room and then we'll get started. Welcome, everyone. We're going to get started in just a minute. Okay, we'll go ahead and get started. Hello, everyone, and welcome to our next webinar in the Back to Basics series, Leases and SBITAs. We're happy to have you here with us today. Before I introduce our presenter, a few housekeeping items. This webinar is being recorded, so be on the lookout later today for an email containing a link to the recording, as well as a copy of the slides and other resources. This webinar will run 50 minutes with a 10-minute Q&A immediately following. If you have any questions for our speaker, please put them in the Q&A box located in the Zoom toolbar. To find that, hover your mouse over the top or bottom of your screen and a toolbar will pop up. This webinar is eligible for 1 hour of CPE credit. We will launch 4 polls throughout the presentation. To receive credit, you must answer 3 of the 4 polls and also complete the short evaluation you will receive afterwards. LSL is using a new CPE system, so please note that the evaluation email will be coming from LC Vista. Please allow up to 1 week to receive this email. If you're having trouble seeing the polls, try minimizing the Zoom screen, as sometimes the poll question box pops up behind it. You may need to click and drag the Zoom screen around to see it. If you're using multiple screens, check each one as it may pop up on another screen. If that does not work, you may need to disable your pop-up blocker. Now, I'd like to introduce our presenter. Nicholas Keathley is a manager in LSL's Assurance and Advisory Department, serving clients in the government sector. With a background in school districts, cities, water districts, and housing authorities, he provides assurance and advisory services, including financial statement audits under Yellow Book standards, single audits, and financial close assistance. He helps agencies translate technical audit requirements into practical, actionable strategies, improving processes, enhancing transparency, and ensuring smooth, confident audit preparation. Whether he's leading an engagement or advising on complex reporting issues, Nicholas is committed to advancing the financial health and accountability of the public agencies he serves. And behind the scenes is Ryan Domino, partner in LSL's Assurance Advisory Department. He will be behind the scenes answering your questions throughout the Q&A, so feel free to put your questions in the Q&A box throughout the presentation. Okay, Nicholas, take it away.
All right. Well, thank you, Rachel. Thank you for that introduction. And thank you all here for being here with us today and attending this webinar. I understand whenever you see GASB 8796, a lot of you all associate a lot of bad memories and a lot of stressful nights with these statements. So definitely appreciate you guys, toughing it out and attending this webinar. The goal is to use webinars like this, and as the years go by, hopefully these statements become less stressful and cause less heartburn. So with that being said, I'll kind of go over a quick outline of what we're going to be covering today. So we'll first be doing a technical overview of the 2 statements. So GASB 8796, this will be a very broad 30,000-foot overview of these statements. You can spend an hour or 2 talking about each statement alone. So we're definitely not going to go way in depth, but we'll give a general overview. Next, we'll go over the financial reporting. So we'll refresh on that. We'll take a look at the journal entries, the disclosures, and the financial statement presentation for these items. And then moving on, we'll look at some of the challenges that have been faced by governments, especially as we head into year 3 for SBITAs and year 4 for leases. We'll talk about what we've seen so far and kind of the lessons we've taken away. And then finally, what a lot of you all probably care about is how are we going to audit this? So we'll discuss some of our audit procedures as a firm, and we'll kind of talk about what documentation we'll be looking at. So with that being said, we'll go ahead and launch our first polling question. So how comfortable are you with GASB 8796. Are you an expert by now? Do you feel pretty good? You understand them for the most part, somewhat comfortable, you have a vague understanding, or D, do you wish these statements would just go away? And for those of you all who answered letter D to this, I understand the pain. If I had this question, I would substitute GASB 87 and 96 with GASB 68 and 75, pension and OPEB. Those are by far my least favorite statements to go through, just very tedious and time consuming. So I understand that we all have our own least favorite GASBs. And so while you all answer that, I'll go ahead and move on to our technical guidance. So before we move any further, we'll first talk about the definition of leases and SBITAs. So again, this is just a refresh. I'll start off with the definition GASB 87. So GASB 87 defines a lease as a contract that conveys control of the right to use another entity's non-financial asset as specified in the contract for a period of time in an exchange or exchange-alike transaction. And so before I move on, I do want to cover a lot of what you'll see in GASB statements 87 and 96 is virtually identical. It's almost as if the GASB copy and pasted GASB statement 87 into statement 96 with the substitution of non-financial asset for IT software. So I won't reread the definition for 96 because it's essentially identical, but I do want to point out the key difference. So it's the right to use another entity's IT software, and they add in this line, alone or in combination with tangible capital assets. We'll talk about combinations later on in the presentation, but virtually you can see that the definitions are identical. And so a couple of key points about the definition. It's pretty short, concise. Every word in the statement's definition is intentional and requires consideration. And I kind of bolded those key terms, so control, period of time, exchange or exchange alike. And I'll be kind of dissecting these terms in the following slides. For the exchange or exchange alike substance, I won't be using a slide to break it down because this term is pretty straightforward. Exchange or exchange alike. Really, does the contract have substance is really what you're assessing. Is it at market value? What you see a lot in the government spaces are these $1 lease agreements. So of course, those would be scoped out. And this is part of, you're seeing this definition. This is part of the reason why statement 87 and 96 are so difficult, is that they're very facts and circumstances based. Essentially, you need to take this definition and apply it to each contract or amendment or agreement, and you have to assess each one by one. You can't really apply statements 87 and 96 as blanket guidance. Unlike what we're seeing with statement 101, where you can come up with an estimate and apply it to a pool of sick leave or vacation. With 87 and 96, you can't do that. You're really forced to go through each contract one by one. So again, we're going over the elements from the definition. The first element we'll cover is control. This is the one that I think when the statements initially came out, kind of tricked up a lot of people, essentially just due to the nature of the asset itself. It's a right to use assets, you're not actually owning the asset. So I'll read this from the statement. A lease or SBITA contract conveys control of the right to use the underlying asset if the government has both of the following. And so that's going to be the right to obtain the present service capacity from the underlying asset as specified in the contract. And then second, the right to determine the nature and manner of use of the underlying asset as specified in the contract. So a couple key things I want to point out here. A lot of this verbiage, present service capacity, nature and manner, a lot of that comes from GASB concept statement number 4, which defines an asset as resources with present service capacity that a government presently controls. And so statement number 4 goes on to define present service capacity as for an asset is its existing capability to enable the government to provide services in which it enables it to reach its mission. So for present service capacity, you can simplify that as being, can you obtain economic benefit from the underlying asset? When it comes to nature and manner, this one can be a little trickier, and that's due to the fact, again, that you're not booking the lessor's assets on your book. All you're booking or capitalizing is the right to use that asset. And so really what the GASB relies on a lot is this terminology as specified in the contract or agreement. So as long as you're operating within those parameters, the GASB has said within their basis of conclusion, as well as their implementation guides, is that you can still determine the nature and manner of use of the underlying asset within or kind of in the scope of a contract. So for instance, if you're leasing a building, you're not capitalizing the building on your books, but you're capitalizing the right to use that building. And I think one of the Q&As in the implementation guide that kind of drives this point home is the GASB got a question where, and it's a scenario where the city is a lessor, they're leasing a building to a separate entity, and they state that the first floor of the building must be used as a restaurant. And so that begs the question, does this contract actually convey control? Does the lessee have the right to determine the nature and manner of use? And so the GASB's answer was yes. Even though that the lessor, which in this case would be the city, is saying that the first floor must be used as a restaurant, it's within those parameters, it's still up to the lessee to determine how and to what extent that restaurant will be operated. So it can be tricky there. Nature and manner can be hard to understand, but I think as you take this and apply it to the facts and circumstances of an agreement, I think it becomes more clear. And then, of course, present service capacity, I think is a lot more straightforward. Are you obtaining economic benefit from the underlying asset? Moving on, so you remember for the definition, it also specified that the agreement needs to be for a period of time. So that kind of helps us dovetail into the lease term, the lease or SBITA term. So the lease or SBITA term is defined as the period during which the lessee or the government, I use government here as the SBITA user, has a non-cancelable right to use an underlying asset. And so the key here is non-cancelable, plus any options to extend if it is reasonably certain that either party will exercise that option, or periods covered by the option to terminate if it's reasonably certain that either the lessor or lessee will not exercise that option. One key point I did want to point out when it comes to the cancelable and non-cancelable periods, if both parties can terminate the agreement at any time without permission of the other party, then you really don't have a non-cancelable period. What the GASB considers this as a cancelable period. So it really should be excluded from the assessment of the lease term. Also, vice versa, if both parties have to agree to extend the agreement, it's considered a cancelable term as well. And so the example they give there is the rolling month-to-month lease. So before moving forward, I did want to go over some lease and SBITA examples that we've seen so far over the years. I think with leases, this is a lot more straightforward because we had leases prior to GASB 87. All GASB 87 did was change the accounting for leases. But again, with your leases, you have buildings, equipment, vehicles, land, machinery. So those are pretty straightforward because they're tangible physical assets. When it comes to SBITAs, the variety that we see is a lot more broad. There's a ton of SBITAs out there, but the ones that we've seen a lot that are very common are you have a subscription software for your accounting or payroll software, ERP systems. The one I always want to point out is lease or SBITA management software. So think about debt book, lease query. These softwares in themselves would be considered a SBITA. Any record management system. So the one we see a lot is Laserfish. Remote learning platforms, that's more for education agencies, data backup and storage applications, and then Amazon Web Services. And this would be considered more of a infrastructure as a service. Now, one thing I did want to point out for SBITAs when it comes to your assessment is that the GASB actually does not define what IT software is in GASB 96. That was something that they deliberated on. I know some users wanted them to define IT software within the statement, but ultimately they decided not to define it just to prevent more problems. They felt like if they defined IT software, it would lead to more problems and more misapplications. So moving on within our technical guidance, we'll talk about what is excluded from your standard GASB 87 lease. So anything short-term, so like going back to the definition for a period of time, you're only going to be looking at leases that are greater than 12 months. So if the maximum possible term under the agreement is 12 months or less, including any options to extend regardless of their probability. So you really, when you're assessing the base, the most minimal term, you're going to assess any options to extend regardless of their probability of being exercised. If that altogether is less than 12 months, it would be considered a short-term lease and would be scoped out of Statement 87. Now, one thing I did want to point out here is GASB 99, the omnibus statement. That statement did provide or rather, it patched a loophole that was existing in statements 87 and 96. Essentially, what GASB 99 did is it prevents governments from entering into short-term contracts, so 12 months or less, and then afterwards amending them to a longer period, and to thus avoid the guidance of 87 and 96. So what GASB 99 says is if you had a previously short-term assessed contract and you amend it, you must assess that contract again from its initial inception. So if you, let's say you have a 10-month agreement that you entered into just to avoid the application of 87 or 96, and then you amended it for an additional 3 years after the fact, you would have to go back and assess it from the initial inception of the agreement. Next, $1 agreements. I know I touched on this earlier. So this is the non-exchange component. So in order for it to meet a GASB 87 lease definition, there needs to be some substance. So of course, a $1 agreement does not meet that definition. Any cancelable agreement. So we talked about this earlier. If both parties have the option to terminate without permission of the other, you really don't have an enforceable term there. So that would be excluded as well. Finance purchase. So this is something that gets called out explicitly in GASB 87. These would be related to contracts that you're going to obtain ownership at the end of the agreement with no termination options. So what the GASB, their view on this is really like a financing installment plan. You're really making payments to obtain ownership at the end. So it's not technically a lease, it's considered a finance purchase. And then regulated leases. So I know, we won't spend too much time talking about these because they're only applicable to a small handful of governments. I know for the FAA ones, I know we have a couple of airports that we audit. So I know it is out there, but it's not really applicable to most governments. But again, these regulated leases will not receive the same sort of treatment as standard agreements would under GASB 87. Immaterial leases. So you'll see this box in every GASB statement, which says that the provisions of the statement need not be applied to immaterial items. So essentially, by now, all governments should have established a capitalization threshold, especially after the implementation years. So when you have an agreement that's extremely small, it's well below the capitalization threshold, you can go ahead and exclude that from the treatment of GASB 87. And then the statement also explicitly identifies any leases for intangibles or biological leases would be scoped out as well. And so those biological leases would be leases of timber, living plants, animals. Intangibles would be more mineral rights, oil and gas rights. Those sorts of agreements would be scoped out. So moving on to the GASB 96 exclusions. So we see here short-term SBITAs, same thing. I won't rehash what we already covered in the previous slide, but same concept there. GASB 99, the patch also prevented the loophole that was existing in GASB 96 as well. So same concept there. Moving on, contract combinations. So these are really when we have combinations where the IT software is insignificant compared to the tangible capital asset. So the example I put here that I think a lot of us are familiar with is a smart copier. So that when you're leasing a smart copier, you're leasing the tangible copier, but as well as the software. And so you need to take a step back and ask, what are you really leasing here? What is the main component of this agreement? In this case, it would be the tangible asset, which is the copier. And so you would not apply the statement 96 to this such agreement. I do want to point that out. You should not be splitting any agreements. So in this case, you would need to apply either GASB 87 or 96. It has to be one or the other. You cannot try to split these contract combinations to apply partial GASB 87 and partial 96. So really this insignificant determination is a judgment call, but typically with invoices and with agreements, you'll be able to see with dollar amounts what is the significant component and what is the insignificant component. Moving on to our exclusions, perpetual computer software licensing agreements. So these perpetual agreements are covered in Statement 51. And these are scoped out really because, again, we talked about in our definition that there needs to be a defined period of time in order for it to meet the definition of a SBITA. So these ongoing perpetual licenses agreements will be scoped out. IT service arrangements. This is one that I definitely wanted to cover. So I see a lot of our governments we have, especially the smaller ones, we're outsourcing our IT services. So those would not be considered a SBITA. You know, you're paying for services, but you're not really paying for a software. So I just want to make that clear that IT service arrangements, whenever you're outsourcing your IT, those would not be considered SBITAs. And then again, we covered cancelable agreements, immaterial items. Same application as you would exclude it from 87 would apply to 96. Now, the last item that I wanted to cover as part of our technical guidance was some key GASB 96 considerations, especially as some of the things that we've seen during our interim planning. We definitely wanted to retouch on this item here. So the first consideration I wanted to point out, it's pretty obvious, but in case we needed a refresh, the Statement 96 only applies to SBITA users. So in other words, lessees of SBITAs. Governments cannot be, under Statement 96, cannot be lessors of SBITAs. I know there are rare instances where states will essentially act like a SBITA lessor with their agencies, but it's very rare and not very common. Most SBITA vendors are going to be private for-profit entities, so the lessor guidance does not apply to governments. Moving on, I did want to cover, this is one of the items that are unique to Statement 96, which are the 3 stages of implementation costs. And these actually come from Statement 51 as well. So you have your preliminary project stage. This is when you're determining the needs of the software. You're going through your bidding, your RFPs, you're assessing the vendors. You're going to have expenses associated with this stage. And then you'll move into the next stage once you actually select your SBITA vendor and you decide to move forward. And so the example I'm thinking of here is an ERP implementation. So you just selected your vendor, whether that be Oracle or Workday, and you start working on your configuration, your coding, your testing, and any installation costs. Those will be considered your initial implementation. And then we have, once the initial implementation phase is completed, you have your ongoing operation and any additional implementations. And so these would be maintenance, troubleshooting, and additional implementation activities. And so I did want to pause here because during our interim planning, we spoke to several governments that are planning on going live with their newer ERP systems in fiscal year 26. And so the one thing I did want to point out is that the initial implementation phase is completed once the first module goes live. So you may have a financial reporting module, you may have an HR module and payroll module being implemented at different times. Once the first module goes live independently, that the initial implementation phase is considered complete. And so that's important because only phase 2 costs, so only initial implementation costs can be capitalized as part of a SBITA asset or prepaid asset. And with these prepaid assets, we really refer to them as subscriptions in progress. They're not identical to CIP because there is no construction, but they are a non-depreciable asset. And you know, the GASB's prescription is to treat these as a prepaid asset if they're not placed into service yet. So once you're going through your initial implementation, you're incurring all these costs related to coding and testing, and these costs tend to be very high. You want to definitely keep track of those, and you're going to be capitalizing those as of year end if you haven't gone live yet. And then any costs associated with phases 1 and 3 will be expensed as incurred. And then training costs at any phase during this process will be expensed as incurred. So regardless of the stage that they're incurred. So again, the key thing here is that initial implementation, you can capitalize those costs, but that implementation phase is ended once the first module goes live. So regardless if you have 5 or 6 modules, once that first one goes live, the implementation phase is considered complete. And so those additional modules would be considered here in the operation and additional implementation phase. So before we move on to our financial reporting aspect, we'll launch our second polling question. So do you currently use a GASB 87 or 96 software? So we're thinking of here is like Debt Book, Lease Query, Lease Crunch. Are you using a software to track your leases and SBITAs? I'll give you all a minute to answer that. So now we'll move on into our financial reporting. So we'll discuss first how does the SBITA liability and asset get measured from the lessee perspective. And this would also be the government using a SBITA. So I use lessee, but the same treatment would be also to a SBITA user. And then we'll discuss on the next slide for the treatment for lessors. But when it comes to measuring, you'll start off with your SBITA liability, and that's really going to be the present value of the payments that are expected to be made throughout the term. And so when you think of present value, you need to have a interest rate associated with that calculation. So this would be the implicit rate. So any rate that's stated within the agreement itself would be considered the implicit rate. But oftentimes we don't see any interest rates associated with these SBITAs or lease agreements. So if that's the case, you'll use the government's incremental borrowing rate. And essentially all that rate is the rate that the government would use if it was going out for any debt that same year. So then once you get your liability valued, you could value your right to use lease or SBITA asset. And so that's going to start off with the initial measurement of the liability, plus any prepayments and any direct costs to place the asset into service. So when you think about your leases, you may have a building that you need to make some improvements to. You would include those prepayments, or let's say you have a piece of equipment and you have costs to get it into service. Those would be considered costs that needed to place the asset into service. So once you have your lease liability and asset booked, your asset will be amortized in a systematic, rational manner. So typically, this is going to be straight line over the lease term or useful life, whichever is shorter. One thing I did want to point out is we're amortizing our right to use asset because it's an intangible. So even if you're leasing a tangible asset, such as a building or a piece of equipment, that right to use is actually an intangible asset. It's not something tangible. So it'll be amortized rather than depreciated. When it comes to reporting on your current financial resources measurement focus, so we're thinking here are governmental fund financial statements, the balance sheet and statement of changes. When you do enter into a lease agreement or SBITA agreement, you're going to record capital outlay expenditure, and at the same time, you're going to report a other financing source. And we'll look at these entries in the subsequent slides, but the treatment will be different on the modified accrual level. And then any subsequent lease or SBITA payments will be treated as typical debt service payments. So you'll have your debt service expense for principal and interest, and then of course cash is going out. So moving on to the lessor side. So the valuation is pretty similar to the lessee side. You're going to recognize this time a receivable, since we're the lessor, and a deferred inflow of resources. The valuation of the receivable is very similar to the liability. It's going to be the present value. But in this case, the GASB does point out you will need to reduce the receivable by any estimated uncollectible amounts. So just like you would for any other receivable. On the other side of the balance sheet, you'll be recording a deferred inflow of resources. And very similar process here. You'll start with the initial value of the receivable, less any payments received prior to the commencement of the lease term. And then in subsequent periods, you'll start to amortize that deferred inflow of resources. And so that offset will be the revenue that you're recognizing from the agreement. And so I came up with these example journal entries because I think with any hard concept in accounting, I think the best way for us accountants to grasp and learn the concept is to look how it gets recorded in the books. So I have some example journal entries in these next 3 slides that I wanted to go through. So you'll see here each slide has it broken out between the modified accrual, so our current financial resources, our governmental funds, and then everything else, our full accrual economic resources. So this would be your government-wide statements, your BTA proprietary statements. So we'll cover the same scenario and we'll look at how it's recorded differently on each basis of accounting. So we'll look at first, how do we recognize the initial recognition of a lease or SBITA at the beginning of the term? So as I mentioned in the previous slide, you're going to record a capital outlay. So that would be an expenditure as a debit. And at the same time, you're crediting your OFS, the other financing sources. And so these would both go in your flow statement. On the right side, on the full accrual basis, rather than booking capital outlay, you'll be booking a right to use asset. And again, this is an intangible asset. And then you'll be setting up a long-term lease or SBITA liability. Then we talk about our subsequent payments. So as we're paying our subscription or lease payments throughout the term, on the fund level, governmental fund level statement, we'll be booking debt service principal and interest, just like we would if you're doing your repayment of bond. You need to separate your principal and interest components. And then, of course, cash is going out the door. When we look at it on the full accrual side, you'll be reducing your liability by the principal amount, booking interest expense, and then, of course, cash is still going out. And then since we did book the leased asset as a long-term asset, you would be amortizing that asset over the subsequent periods. So we'd be booking our amortization expense very similar to the way we depreciate an asset, and then your accumulated amortization. Now, looking on the other side, the flip side, how are these transactions reported from the lessor's perspective? And so we have here, I put them side by side, and really it's not necessary because the accounting is identical for the fund level, the governmental fund level versus the full accrual economic resources level for lessor accounting. And this is really one of those rare times that you're going to see a long-term asset on the governmental funds balance sheet. And that's really because it's getting offset by the deferred inflow. But with that being said, we'll go through the entry. So at the inception of a lessor lease, you're going to book a receivable at the present value of the expected payments, and then you'll credit the deferred inflow to offset it. And then same thing here in the full accrual basis. Then when it comes to your subsequent payments, so as you're going through the lease throughout the term, you're receiving cash for your payments. At that point, the portion of the cash is going to be allocated to interest revenue, and a portion will be allocated to lease receivable as you're working through that present value. And then you would be amortizing your deferred inflow in a systematic manner. So this could be using the effective interest method or straight line method. And so typically these entries are very identical period to period, just with the amounts changing. And then I did want to go over this example when we have prepaid subscriptions, just because, as I mentioned in our interim planning, we talked to several governments that are working through an ERP implementation process as we speak. So when it comes to recording initial implementation costs, on the governmental fund level, you would be booking a capital outlay expenditure, just like we saw previously, and then any cash going out. On the full accrual side, this is where you're going to be tracking your prepaid asset. And so the terminology we've been seeing is subscriptions in progress. Again, subscriptions in progress should not be recorded with CIP. Again, because CIP is going to be working with tangible assets. So you can include this on your capital asset roll forward. And in fact, we encourage it. But you do need to have the SIP and the CIP broken out separately. They should not be grouped. But nonetheless, on the full accrual basis, you'll be booking the prepaid asset. And then, of course, cash is going out. And then if this was a conversion entry, you'd be reversing the capital outlay on the fund level. And then once the SBITA asset is placed into service, you'll record the standard capital outlay and other financing source. So just like we saw in the previous slide, and this will be using the present value of the lease liability. And then on our full accrual slide, we'll reduce or remove our subscription in progress. We'll book our capital asset. So once it gets placed into service and our term begins, and then of course we'll record our SBITA liability. So I just wanted to point out for those of you all who are going through an initial implementation phase, as of fiscal year 2025, any funds or resources that you spent on the initial implementation should be tracked as a prepaid asset as of year end. And then next year, in fiscal year 26, if you've gone live with your first module, we'll be booking this entry, which is removing the prepaid asset. And now we're moving it to a depreciable or amortizable asset category. Next, I did want to cover the financial statement disclosures because leases and SBITAs have a good amount of disclosures associated with them. So when it comes to our lessees or SBITA users, first thing I wanted to point out is that these disclosures can be grouped for practicality. So I think when you're using a software like DebtBook or LeaseQuery, it's going to spit out a disclosure for each separate agreement. And for some of our governments, you can have 100 agreements, different types. So of course, you wouldn't be expected to book a separate disclosure for each separate SBITA or lease. You could group them by like agreements. So if you had various lease agreements for equipment, you could group those, and then you can separate those from leases for buildings. And so you would want to include a general description of the agreement, including any terms, conditions. You are required to disclose the total amount of the assets, so the subscription or lease assets and the related amortization. Typically, we see these on the capital asset roll forward, and I'll cover that on the next slide. Any variable payments. So I didn't cover these earlier, but variable payments will be excluded from the initial measurement of the lease liability. And when we're thinking of variable payments, they need to be truly variable. They can't be fixed in substance. So this, an example I like to give for this one is user seats. What we've seen with our school districts in the past is you could be using an educational software that's dependent on the number of users in the classroom. So a truly variable payment would be dependent on the number of users. So let's say you had 0 users for a month, you'd be charged $0. Now on the flip side, if you had a minimum threshold, so let's say for 0 to 30 users, you're getting charged 500 a month regardless. Those would be variable payments that are fixed in substance. Principal and interest requirements to maturity. So these are tables that I actually have an image in the following slide. So we'll take a look at them better. But just for an overview, you'll be breaking out your principal and interest payments for the next 5 years, and then after that in 5-year increments, all the way to maturity. Any commitments for leases or SBITAs that have not commenced. So let's say you've signed an agreement, but nothing's taken off yet, you would disclose those as well. On the lessor side, we'd be disclosing same thing, general description of the agreement. You'd be also required to disclose the total amount of inflows of resources during the year. So any revenues recognized, if it's not clearly displayed on the face of the financials. Again, any variable payments that were excluded from the initial recognition of the lease liability. And then this one's a special disclosure. So only if your leasing activity is a principal ongoing activity, you would be required to disclose the 5-year tables for the lease receivable until maturity. But the key thing here is it must be an ongoing activity, principal ongoing. So let's say you just have 1 or 2 lease agreements, it's not really material to you. The 5-year tables on the lessor side would not be applicable. And then one thing I wanted to point out, if you are a governmental entity that has those regulated leases, those come with their own set of separate disclosures that are covered in Statement 87. So I did want to go over some images of disclosures just because I think a visual presentation will make this more clear. So we saw in the previous slide that you're required to separate the SBITA or lease asset versus compared to the amortization. So this example is from the GFOA ACFR template. And so you see here in their capital asset roll forward, they've included their SBITA assets and their lease assets within the capital asset roll forward under intangible assets, because again, that right to use is an intangible asset. And then we have the related amortization down here. So it's separated. One thing I did want to point out, we saw this more so on when governments were initially implementing the guidance. We saw governments that would exclude the lease and SBITA assets from the capital asset roll forward, and they would put them in their own disclosure. While that's technically still in compliance with GAAP, it's not necessary. GASB statements 87 and 96 specifically identify SBITAs and leases as capital assets, and thus they should be included with the capital asset roll forward. There's no need to separate them from your other capital assets. Moving on, this is an example disclosure of a lease receivable. So here they're disclosing a description of the receivable and the revenues recognized during the period, as well as the balances of the deferred inflows and receivables. One thing that wasn't included in this, the GFOA template, they didn't have the 5-year tables. And so you could safely assume that this leasing activity was not a principal ongoing activity for the entity. So this is all they had to disclose. Moving on, looking on the other side of the statement of net position, we have our changes in long-term liabilities. So again, we saw governments in the initial implementation years separating out the lease liabilities and lease assets from the roll forwards. There's no need to do that. Lease liabilities and subscription liabilities are considered long-term liabilities, and thus we do recommend that they be included in the long-term liability roll forward. There's no need to call them out or separate them. And the last example I have here is I just really wanted to show the principal and interest tables. So in this case, they did not have one that extended beyond 5 years, but you would be required to disclose for your lessee leases and your SBITAs the principal and interest requirements for the individual 5 years subsequent to the financial statement date, and then any periods after that would be grouped in 5-year increments. A couple of key financial statement considerations that I did want to point out just from what we've seen over the years. I think I already covered these top two. So lease and SBITAs are capital assets. They're explicitly identified in the statements, so they should be grouped with the other capital assets in the footnotes, and vice versa with long-term liabilities. One special item that I've seen a lot of governments miss, and this actually got addressed in the GASB implementation guide in 2025. Interest revenue is considered non-operating revenue, even if the leasing activity is a principal ongoing activity. So this is one that we've seen a lot of governments not really disclosed properly, but it hasn't really been an issue because the interest component is considered immaterial. But if you're looking at the proper disclosure between your principal that you're receiving as a lessor versus your interest revenue should be considered non-operating revenue. And if it is a principal ongoing activity, that principal portion would be recognized as operating. So this got explicitly identified and addressed in the most recent implementation guide. Another troublesome area that I've seen in the financial statements are when it comes to the cash flow issues. And that's, I think part of that is because these statements really don't talk about the treatment in the statement of cash flows. But one thing I did want to point out and what we saw with our journal entries is that whenever you have the inception of a lease or SBITA, there's no cash exchanged. So you're debiting your capital assets, expenditures, your capital outlay, and you're crediting your other financing sources on the modified accrual side. On the full accrual side, you're booking the asset, the right to use asset, and you're crediting the liability. In either of those transactions, we didn't see cash going out the door. So unfortunately, I have seen governments that put the issuance of lease in their capital and financing activities as part of a cash outflow, and that is incorrect because an issuance of a lease does not have an exchange of cash. Now, on the flip side, lease and SBITA payments, so the repayment throughout the term, those would be cash outflows, but the initial inception, the issuance of the lease or SBITA would not be considered a cash outflow or inflow, but it would need to be disclosed as a non-cash financing activity. So that would be typically done as a reconciliation or an additional disclosure below the statement of cash flows. We should be disclosing our significant non-cash capital and financing activities, and thus the issuance of a lease or SBITA would be considered one of those non-cash capital and financing activities. So before moving forward, we'll be going over polling question number 3. So I know I've talked about this a lot throughout the presentation, but just to gauge the government out there, is your government planning on or currently undergoing an ERP implementation? So while you guys answer that, we'll go ahead and move on to our next section. So we'll talk about our lesson learned and some of the best practices we've seen throughout the year. And apologies if I speed through these because I'm just trying to make sure we have enough time at the end to go over any questions. But kind of what we've seen over the past 3 to 4 years with leases and SBITAs. The main thing we want to discuss is you need to prepare early. This is, I think, as we've seen over the past couple of years, and again, due to the nature of the statements, these are very facts and circumstances statements. So you're going to be spending a lot of time going through agreements, amendments, any modifications will require you to look at those individually. So definitely prepare early. Don't make this one of your last closing items. Even though the journal entries or disclosures, those might be last on your list, you should not be waiting to the end of the year to try to identify and inventory all of your leases and SBITAs. That should be an ongoing dynamic process throughout the year. Plan for challenges. So even if you're using a SBITA or lease software such as DebtBook or Lease Queries, plan for issues. I know I've seen my fair share of issues whenever the journal entries or disclosures get spit out and it's not agreeing to the financials and something was entered incorrectly. So give yourself time to address those challenges. And we went over the journal entries earlier in this presentation. So even if you're relying on the lease or SBITA software, you should be generating those entries and reviewing them one by one and making sure, does this look correctly? Are the account numbers correct? The next lesson learned that we've seen is lack of departmental communication. With this, I like to say, you'd be surprised how many people in the government can enter into a contract. So I think a lot of governments learned that the hard way on their initial implementation years. There's people entering the contracts that they weren't aware of. And then when we did our completeness tests, we were finding leases they weren't identified initially. So make sure you communicate with all your departments throughout the years and make sure you're identifying who can enter agreements and make sure we're considering the possible option to limit whoever can enter in these long-term agreements. Next, make sure we document everything that could be applicable and not applicable. So even the agreements that you've scoped out for the exclusions that we covered earlier, make sure you're keeping those for documentation purposes because we may be pulling those as auditors. Review for any amendments. So review your lease or SBITA listing. Look at the agreements that are about to end or have ended and just confirm that we did not amend those agreements, that they're not still ongoing. I know this is an issue we've seen with governments before where they see that the initial term ended and they think the lease is removed. And then in a subsequent period, they figure out that the lease was still ongoing through an amendment. And thus they have to have an adjustment booked in the prior period if it's considered material. Review your roll forward for accuracy. So this is something we ask for as auditors. Before you hand that over to us, ensure that your beginning balances agree to your prior year endings. And so again, watch out for modifications and terminations because if you go in the lease software, so let's say DebtBook or Lease Query, and you enter one of those incorrectly, that could actually throw off your beginning balances. So make sure modifications and terminations are entered correctly in the correct period. So moving on to some of our best practices, we definitely recommend reviewing the lease and SBITA listings, kind of like I mentioned earlier. You want to look at the upcoming dates, especially the upcoming termination dates, and you you want to verify and reach out to whoever's responsible for that agreement and verify, is this agreement still in place? Did we extend it? Is it truly terminated? So definitely reach out, use that list, and identify any upcoming leases that are about to end. Search for exclusions. So I know as an auditor, whenever I am testing leases or SBITAs, whenever I pick up an agreement, these are going to be the first things I look for. So before I start spinning my wheels and trying to assess the agreement and the payment terms and all that, I'm going to be looking for exclusions. So I'm going to look at the period, see if it's short term, see if either party can cancel, and verify that there's an exchange component. Make sure it's not a non-exchange agreement. Another best practice we recommend, primarily to the accounting department, is perform a keyword search on your GL to identify potentially missed SBITAs. So this is actually something that we do on our end as an auditor. We're going to be scanning your GL, looking for key terms such as rent, lease, software, subscription, keywords like that. Once you identify those, you might want to take a look and see if there's any recurrent payments associated with those key terms. If you are seeing terms like that in a recurrent payment, let's say quarterly or monthly throughout the year, you may need to assess that further as a potential lease or SBITA. Other best practices, we recommend creating separate GL accounts to track your leases and SBITAs. So if you haven't already, it's highly recommended that you create your own GL accounts to track those. We also recommend reviewing your minutes to identify any potential leases or SBITAs. So for a lot of our clients, any long-term agreements need to be taken to City Council. So that's a great way to identify any lease or SBITA agreements that you may have missed. Meet with the purchasing department throughout the year. We do recommend consider using a lease or SBITA software. I would say if you have more than 10 leases and SBITAs, I think it's kind of worth it to invest into a lease or SBITA software. It makes your life so much easier rather than relying on Excel. So examples we see out there are DebtBook, Lease Query, and then consider using consultants to assist with the review and input of lease agreements. So I'll use this as a plug for LSL. We have our own government CAS team that focuses on this, and they go through lease and SBITA's documentation and uploading for some governments. So definitely, if you have a ton of agreements and you don't have the time and effort to put into identifying and reporting these leases and SBITAs, this is an option that's possible for you. And so I know we're running out of time, so I'll move through these pretty quick and highlight the key points here. But what are we going to be asking for as auditors? So one of the main pieces of documentation that we're going to be asking for is the roll forward. So the lease liability and capital asset roll forward that should be showing the beginning balance of the lease liability plus any additions, reductions, and then the ending balance. And on the other side, we'll be looking at the assets as well. We'll be looking at any calculations for accrued interest or the receivable and payable side. And then what information are we going to be asking for? So we're going to be asking for a listing of leases that you consider to be not qualify under the statements. We'll be looking at copies of any lease agreements or amendments. So these would come through our additions testing. If you have significant additions, we might be pulling samples of those. And so we'd be asking for the original agreements and any amendments associated with that. Make sure we're going to be asking for documentation related to the materiality policy, the likelihood of exercising extensions. So once you make that determination on the lease term, we're going to be reviewing your judgment if pulled. And then any estimations of years for auto renewals. So these would be more prevalent to your subscriptions. When we think about your subscriptions, technology is constantly changing. So if you have an auto renewal that goes out 5 or 10 years, you need to ask yourself, are we really going to be using this technology for the next 5 to 10 years? Then we'll be looking at the journal entries associated with these, and especially the government-wide entries. We'll be looking at the GL detail to perform our completeness test. And then finally, we'll be reviewing the financial statement disclosures. And so what kind of tests are we going to be doing as in our substantive procedures? We'll be looking at the accuracy of the schedule. So again, we'll talk about agreeing the beginning balance and the ending balances to the financial statements and to the GL. We'll be doing a completeness test, so making sure that everything is included in the roll forward. We'll be scanning the GL, and then we'll be testing the financial statement disclosures, making sure that you have all the disclosures completed with the adequate and accurate information. And if we're assisting with that preparation of those disclosures, we'll still be asking for the supporting schedules to look at those. So finally, going into our last polling question of the day, what do you think is the biggest challenge that will be faced with this process? Is it A, maintaining a list of leases and SBITAs, B, engaging departments, C, accuracy of their journal entries, or D, all of the above? And as you are answering that, I'll go ahead and move on. I just wanted to point out real quick, there are some resources out there that go a lot more in depth. I know this was a fast-paced presentation. We had a lot of information to cover, but the California State Controller's Office has its own certain area that covers GASB 87 and 96. The GFOA also has their own resources that are very helpful. And then lastly, the GASB implementation guides, I highly recommend those. You'll see Q&As that get answered directly by the GASB. And so there might be scenarios that you have that are very difficult to assess. They may have already been addressed in the implementation guide. And then LSL, we have our own resources. So we do have a GASB 87 blog, a GASB 96 blog, and then of course webinars like this and previous recordings. And so before we head into our questions, I did want to point out that our next webinar coming up is going to be September 10th with Ryan Domino. So he's a partner here in our government practice, and he'll be covering the Uniform Guidance Encore presentation. So again, that'll be September 10th at 1:30 Pacific time. And so with that, we'll go ahead and open it up for questions. I'll go ahead and look in the Q&A box and see what questions have been asked. So I see a question there. Could you please share the recent GASB clarification mention about SIP, so subscription in progress? So the GASB didn't actually release a specific guidance for this one. With this one, what the GASB did, or not the GASB, what the GFOA did is they created a video for this, and they called this Just the TAD. And so definitely, if you reach out to me after this webinar, I can send you a link to that video. But essentially, the GFOA goes through an example. They have example journal entries, and they discuss how subscriptions in progress should be recorded. So all the GASB says is that you should be recording a prepaid asset, but other than that, they don't give you very specific guidance. So definitely you'd want to rely on the GFOA guidance in that situation. So a question was, aside from the recording of the webinar, are we going to be sharing the slides? And the answer to that is yes. And sorry, I'm sifting through these questions. A lot of these questions are very client specific, and so trying to see which ones we can answer online. So we have a question here about modules, and I'm assuming that these are related to an ERP implementation. So again, you're going to be tracking your costs associated with the first module or group of modules. So it doesn't have to be one module. It could be a group of modules that you go live with. But nonetheless, whenever that initial module individually or group of modules goes live, that will be considered the end of your implementation period. Any costs associated after that, if they are significant, you'd have to assess those and possibly treat those as separate capital outlays. But when it comes to recording it as a prepaid asset as implementation costs, that would only be applicable to your initial implementation costs. So That initial implementation phase ends whenever the first module or group of modules goes live.
Okay, I think that's all the time we have for today. Thank you so much, Nicholas, for your presentation. That was really great. We did have a lot of questions that were very specific, so please do feel free to reach out if you need more information. And just a reminder that we will be sending the link to the recording and the slides later today. Thank you very much. Have a great day.